Picture this. New York City, October 1929. The streets are alive with the hum of prosperity. Taxi horns, laughter spilling from jazz clubs, the clatter of typewriters in glass-walled offices. Stock tickers rattle out endless streams of good news. Bankers toast to another record-breaking day. Ordinary people, from shoe shiners to secretaries, are swept up in the euphoria, convinced that the good times will never end. But beneath the surface, something is quietly unraveling. The paradox is as old as finance itself. Why do the worst crashes always seem to arrive when confidence is at its peak? Why do we miss the signs until it's too late? It's easy to believe that disaster is always somewhere else, sometime later, someone else's problem. But history whispers a warning. What if the next collapse is already brewing, hidden in plain sight, while we're all looking the other way? Are you sure you'd see it coming? Stability is seductive. When markets rise and jobs are plentiful, it's human nature to believe the good times will last. We tell ourselves, this time is different, convinced that new technologies, smarter regulations, or global cooperation have tamed the chaos of the past. The system feels safe, almost invincible, yet history is littered with the wreckage of societies that believed exactly the same thing. This is the power of normalcy bias, the mental trap that convinces us tomorrow will look just like today. It blinds us to warning signs, muffles dissenting voices, and turns skepticism into heresy. The more stable things appear, the more we trust the illusion, even as cracks quietly spread beneath our feet. The question isn't whether the illusion will break, but when and whether we'll notice before it's too late. In the months before the 1929 crash, Wall Street was a temple of optimism. Newspapers trumpeted the new era of endless prosperity. Radio hosts assured listeners that stocks could only go up. Even the most respected economists, like Yale's Irving Fisher, declared that the market had reached a permanently high plateau. Yet, beneath the euphoria, warning signs flickered: soaring debt, rampant speculation, and a widening gap between stock prices and real economic growth. A few contrarians sounded alarms, but their voices were drowned out by the chorus of confidence. The public, intoxicated by easy gains, ignored the risks. Even seasoned bankers and policymakers dismissed the possibility of a collapse. When the crash finally came, it seemed to arrive out of nowhere. But in truth, the disaster had been hiding in plain sight, camouflaged by collective denial and the seductive power of a good story. In the mid-1990s, Southeast Asia dazzled the world. Economies like Thailand, Indonesia, and South Korea posted double-digit growth, attracting waves of foreign investment. International headlines hailed the Asian miracle, and local leaders boasted of a new era of prosperity. But beneath the surface, debt-piled-up currencies were pegged to the dollar, and financial systems grew dangerously exposed. When Thailand's currency suddenly collapsed in 1997, panic spread like wildfire. Investors fled, currencies tumbled, and once booming economies ground to a halt. Trust in banks, governments, and even neighbors evaporated almost overnight. Millions lost jobs, savings, and hope, shocked by how quickly confidence could turn to chaos. The lesson: trust is the invisible glue of finance. But when it snaps, the fall is swift and brutal, leaving no one untouched. Fast forward to today, and the echoes are hard to ignore. Global debt has soared to unprecedented heights. Real estate and stock markets in many countries look eerily inflated, and faith in central banks borders on religious. We're told that new tools and smarter policies make the system safer than ever. But are we repeating the same mistakes, trusting in stability while ignoring the cracks? What warning signs are we missing right now, hidden beneath headlines of growth and recovery? Are we so confident in our experts and institutions that we've stopped asking uncomfortable questions? History suggests that the next collapse rarely looks like the last, and it almost always catches the majority off guard. The real risk may not be what we see, but what we refuse to see, until it's too late. For every headline about a market crash, there are millions of untold stories. In 1998, a Thai shopkeeper watched her life savings evaporate overnight as the bot collapsed. In 2008, an American family lost their home, forced to pack up decades of memories in a single weekend. A young graduate in Spain once hopeful for a bright future, found himself jobless and adrift as the economy crumbled. These are not just numbers on a chart. They are lives upended, dreams deferred, and communities fractured. The pain of financial disaster ripples far beyond the trading floor, leaving scars that last for generations. It's a sobering reminder. Behind every collapse are real people, blindsided by forces they never saw coming. History's disasters share familiar warning signs: soaring debt, unchecked speculation, and a chorus of voices insisting it's different this time. Groupthink blinds even the smartest minds, making skepticism a rare but vital asset. To protect yourself, question easy narratives, watch for uncomfortable data, and resist the comfort of consensus. The next crisis may not announce itself, but those who stay curious, skeptical, and alert to patterns are far more likely to see the storm before it hits. Why do we keep falling for the same illusions, generation after generation? Perhaps it's human nature to trust in stability, to hope that tomorrow will be just like today. But history urges us to look deeper, to question what seems certain. What lessons have you learned from past crises? Have you ever seen warning signs others missed? Share your thoughts and stories in the comments below. And if you crave more hidden truths from financial history, don't forget to subscribe.